What you see on the screen is a real tax return summary. We've redacted the names and the Social Security numbers from the document you see attached. We've got a short history, which we put in. Back in 2016, they had a prior CPA. Could have been a non-account, non-CPA. 2017, prior CPA. We were engaged in late 2017. It took a month or two. Did some analysis, some review of what took place in the past, and came to the conclusion that they were overpaying taxes. So we implemented a tax plan. And you can see the change from 17 to 18. And when I see the change, if you can see the mouse kind of moving around on the screen underneath 17, the taxable income was 449. The next year was 439,000. Scroll down where I circle the numbers. The tax was $155,000 in 2017 on almost the same taxable income. The tax bill dropped to $104,000. So it dropped $50,000 in 1 year on almost the same income. The next year, 2019. Now, what you don't see there is cash flow for 2019 is still 440,000 plus. Taxable income is 218,000. There's some clever things that can be done. They were done. But the cash flow, so there's no lifestyle change. We didn't tell them to spend any more money. They didn't have to spend any more money. So their lifestyle did not change. Their cash flow remained identical to prior years. But taxable income, significantly lower, $217,000. And as you can see down the column, again, where I'm kind of moving the mouse, the total tax was $36,000. So in 2 years, where I put a little at the top, they paid $140,000 in taxes over a 2-year period. If we go back to 16 and 17, they were paying $155,000 a year, or $310,000 in taxes for 2 years. We cut their tax bill in half. Cash flow still the same. And that's what we've already banked. We've already banked $170,000 in tax savings. We know if it's done correctly, that they're going to save another $480,000 in additional taxes over the next 4 years. So as long as they follow our recommendations, we're there. Now, we can't make taxpayers follow our recommendations sometimes. Excuse me. But we believe they will. There's no reason not to, because their cash flow is still good. So anyway, please feel free to watch this video over again so you can see the numbers. So again, these are real numbers for real taxpayer, real situation. Every situation is different, but this one worked out really well. Unfortunately, it worked out really well because the prior setup was not optimal. There was a couple flaws in it. Nothing's perfect. Now, I'm sure ours isn't perfect either. Could we get better? Maybe. But if your cash flow is $440,000 and your effective tax rate 17%, it's not a bad deal. If you look at the tax tables, you're not making very much money paying a tax rate of 17% when you know the tax table at $440,000 is much higher. So anyway, something for you to review, look at. Thanks a lot for your time. Thanks. Bye.